Your wealth is far more fragile than you think. Paychecks arrive on time, home prices climb. The news says the economy is steady, everything seems safe. But danger has already quietly crept into your life. Walking down the street, scrolling your phone, seeing friends' flashy vacations, new cars and luxury homes, you feel like you're falling behind. Wrong. The real risk isn't in their hands. It's buried deep in a system you can't see. I've seen ordinary families' homes, savings and investments vanish in an instant. It's not bad luck. We keep repeating the same 5 deadly economic mistakes. Buying a house, refinancing, following trends, trusting so-called experts, chasing hot markets. These all look safe on the surface. But in reality, the risk quietly accumulates. When the next crash hits, will you get swept up? Or will your money actually work for you? As a total finance rookie, I will tell you the answer. Almost everyone builds their financial life on one lie. Crises are random, rare, and basically impossible to predict. So the best you can do is work hard and stay positive. Buy what everyone calls safe, and trust the professionals in suits. Trust they have already stress-tested the system for you. That story is comforting, but it's also why ordinary people get fed into the same machine every 8 to 15 years. Because when a crash finally arrives, at first, you barely feel it. Everything seems normal, maybe even calm. Your paycheck arrives. The news reports steady growth. Unemployment looks low. That was the vibe before 2008. Nothing looked like a crime scene. It looked like success. Owning a home was elevated into a moral achievement, treated as a wealth strategy. People weren't just buying shelter. Back then, banks made money by issuing mortgages and patiently waiting for borrowers to pay them back. That model has limits if you're responsible for a loan. You need to care whether the borrower can actually repay. Once this machine starts running, it needs more fuel. More mortgages, more signatures, more houses, more debt. So standards slip, and then slip again. This is where most people still get it wrong. The system doesn't collapse because borrowers suddenly became irresponsible. It collapses because the whole structure rewards quantity over quality. If you can profit from creating debt without taking the ultimate loss, then debt simply grows faster than real income. And ordinary people live inside this flawed design, blissfully unaware. A family buys a house for $400,000, and prices keep going up. On paper, they feel richer, not because they earn or save more, but simply because the number attached to the same walls and roof has risen. Then they refinance, borrowing against the higher value. Then, the tiniest change shatters the magic. Home prices stop rising. It's not a sudden crash at first, just stagnation, then a decline. Suddenly, that $400,000 house is worth $350,000. But the mortgage still stands at $390,000. Now the family is in serious trouble. That's why "no one could see it coming" is usually just a slogan. It's a comforting slogan, not an actual analysis. The warning signs were never hidden in some secret vault. They were always there: too much debt relying on rising prices, over-trusting structures no one plans to inspect, relying on the fantasy that slicing up risk makes it disappear. And the calm ends here, once homeowners start missing payments. The jars full of mortgage cash flow start running dry. The bottom layers take the hit first, then cracks appear in the middle layers, and even the ones that seemed safe begin to wobble. What was once labeled diversified starts to behave like a contagion. What was labeled prudent starts to behave like radioactive material. The myth I want to break here is this: people think wealth is destroyed at the moment of impact. In reality, it's usually already destroyed during the periods that seem smartest on the surface. During years when ordinary savers were praised for following the safe trend. During months when experts dressed up dirtier motives in prettier language. If you think it's just a one-off glitch, The next event will prove otherwise. Because 2008 wasn't the first time anyone mistook rising prices for real value, nor the first time buyers stopped asking how much something earned, and only asked whether they could sell it higher tomorrow. Change the outfit. The mechanism remains. Before toxic mortgages, there was a frenzy where investors abandoned fundamentals. They ignored logic and financed the future based on narrative alone. That's where the next crack opens. When was the last time you saw people buying only a story? Buying a story and completely ignoring the actual numbers. That's why the old moral slogans collapse under pressure. Work hard, save steadily, and you will be fine. Hard work can earn income, but it doesn't automatically buy ownership. Without assets that can reprice with inflation or generate real cash flow, your daily effort is just a treadmill. Your paycheck arrives in dollars, losing purchasing power. Your savings lag behind rising costs. Your expenses climb faster than income. The public is told to be disciplined, patient, and financially literate. But the system itself continually rewards those closest to scarce assets, closest to pricing power and leverage. That's hierarchy, not smarts or discipline. Owners of bottleneck resources cash in on everyone else. Visualize it. One person sits in a boardroom, seeing land, energy, credit, or productive businesses as pieces on a map. Another stands under fluorescent lights at a grocery store, putting back an item because the total adds up. Both are participating in the economy, but in totally different ways. When oil quadruples in a few months, owners of resources, infrastructure, or pricing power can pass costs on. Consumers can't. Workers usually can't. Retirees absolutely can't. So when someone says inflation hurts everyone, it's technically true. But in real impact, it is deeply misleading. Everyone gets hit, but not equally. Notice how this tiny action interrupts the system. In Japan, the loop is simple. Low rates make borrowing seem harmless. Land prices make collateral look stronger. Strong collateral unlocks more borrowing. The machine misreads prices as safety. Same psychology in the 1920s, just a different outfit. Low barrier credit turned the stock market into a social escalator. Borrow a little, buy a little, watch numbers climb, borrow more. Once the crowd sees action, judgment is replaced by mimicry. A pause forces you back to judgment, dragging decisions from the emotional market to reality. Table, pen, numbers, your name. Boring itself becomes the antidote. Because when people get financially injured, the ultimate mistakes rarely happen at the collapse point. They happen earlier, in seemingly harmless, quiet moments. Midnight, phone lights up, charts vertical, comment sections full of certainty. Someone says this is the way to wealth, and your body reacts before your brain. Shoulders tense, breath shallow, you feel behind. That feeling usually marks a bad trade. Not research, not valuation, not discipline, just urgency disguised as wisdom. Writing it down and waiting 24 hours exposes the truth. If the idea still matters the next day, it survives. If it only matters when your pulse races, it was never an investment argument. It was just a trigger. It also means giving yourself permission to step away. Exiting is a financial skill. If an asset only matters while strangers are excited, you don't own it. You simply rely on future hype. If a strategy requires perfect timing, constant attention, or trust in online experts buried in bots, hype, and alliance incentives, that's not a wealth system, that's a stress machine. True compounding is usually boringly steady, lowering risk, generating cash, letting time do its work.